Welcome to the Deep Dive, where we unpack the data to reveal the true story behind the headlines. Today, we're diving deep into a really perplexing situation, CAVA Group's Q2 2025 earnings. You see, CAVA comfortably beat Wall Street's earnings per share expectations. I mean, a clear win, right? But here's the puzzle. Their stock then plunged dramatically, lost about 22% of its value in after-hours trading on August 12th, 2025. So why on earth would a company's stock plummet so sharply after beating profit forecasts? What does this tell us about how the market assesses a growth company like CAVA?
It's a classic Wall Street dilemma, isn't it? Do you reward today's strong operational performance or, punish a potential slowdown in future growth?
That's the core question, absolutely. And it highlights just how misleading those surface-level headlines can be. Our mission in this deep dive is to move beyond that initial shock. We'll integrate CAVA's official performance data with the real-time market reactions using a structured 5-part framework from our source material. Our goal is to equip you, the curious learner, with the full understanding of the underlying drivers and the implications of this paradoxical quarter.
That sounds like a powerful way to cut through the noise. Okay, let's get started. Now for slide 1, the at-a-glance scorecard. To really unpack this paradox, let's kick things off by looking at the raw top-level numbers, what we're calling the at-a-glance scorecard. Looking at the data for Q2 2025, CAVA reported revenue of $278.2 million. Now, that's a robust 20.3% year-over-year growth compared to the $231.4 million in Q2 2024. On the surface, that sounds great, really strong growth. But here's the confusing part. Net income came in at $18.4 million. That's actually a 7.0% decline from last year. And diluted EPS earnings per share followed suit at $0.16 for Q2 2025, a 5.9% decline year over year.
Right. It's those last two numbers that truly caught the market off guard, especially when you compare them to analyst expectations. While that 20% revenue growth is solid, CAVA's $278.2 million actually missed the Wall Street consensus. They were expecting something closer to $286 million. And for a high-growth company like CAVA, the top-line miss is a significant concern for investors, a big red flag, really. However, on the flip side, CAVA's diluted EPS of 60 cents comfortably beat the consensus. The street was looking for $0.13, so CAVA beat that by over 23%. So you have this revenue miss, but an EPS beat, yet the stock plunged that dramatic 22% in after-hours trading. Initial analyst reactions, according to our sources, they really centered on the sharp slowdown in same-store sales and that disappointing cut to full-year guidance. We'll get into that. It's fascinating how different parts of the market weighed those positive and negative signals, isn't it?
It really is contradictory. If revenue grew so strongly, how on earth did their net income and EPS actually decline? What's the trick here? Is it a sign of operational trouble or like something else entirely going on?
That's the paradox, exactly, and it's critical to understand. The real insight here is that CAVA's core operations were actually very healthy. When we deconstruct these growth and profit discrepancies, we find that income from operations, which is profit before interest and taxes, it actually grew by a healthy 21.7% from $16.1 million up to $19.6 million. That growth outpaced revenue growth, which indicates positive operating efficiency within the business itself. Things were running well. So the apparent profit dip, that was almost entirely due to a significant change in provision for income taxes, a tax thing. In Q2 2024, this was a minimal expense, just $287,000, tiny. But in Q2 2025, it ballooned to $5.3 million, a massive increase. This huge jump in tax expense more than offset the strong growth in operating profit. Now, if you look at adjusted net income, which is a non-GAAP measure basically, it helps us understand the underlying business by adjusting for things like this unusual tax expense. Well, last year's adjusted figure would have been around $16.8 million. Compare that to this year's $18.4 million net income, and it reveals an underlying profit growth of 9.5%. So this demonstrates that the headline profit decline was primarily a function of tax normalization, not, deteriorating business fundamentals.
Ah, okay. So the market focused on that headline EPS decline and the revenue miss. But beneath the surface, the operational profitability story was quite different, largely due to taxes normalizing. That's a crucial distinction, one many might miss just looking at the headlines. Moving to slide 2, the engine of profitability. All right, with those top-level numbers in mind, let's transition now. Let's look at the operational health of the company itself. We're calling this section the engine of profitability.
Right. And for any restaurant chain, the most important measure of core operational health is the restaurant-level profit margin. This metric tells you how much profit each individual restaurant makes from its sales, before you account for corporate-level expenses like HQ salaries. A high and stable margin indicates that the fundamental business model selling food is efficient and sustainable. CAV reported a restaurant-level profit margin of 26.3%, which is, frankly, remarkably strong for the fast casual industry. It really points to exceptional operational excellence. And what's even more impressive is its resilience. This margin only decreased slightly, just a tiny bit, from 26.5% in the prior year, barely moved. This stability is particularly noteworthy because management explicitly mentioned facing cost pressures. They talked about input costs associated with the launch of grilled steak. Steak's more expensive, and also incremental wage investments, paying people more. When you look at the cost breakdown of the sources, yeah, food, beverage, and packaging costs did tick up slightly. That reflects the steak. But labor and occupancy actually showed slight improvement as a percentage of sales.
The ability to absorb these headwinds with only a 20 basis point decline, that's 0.2% in an already elite margin. It just demonstrates exceptional operational control, a really robust store-level economic model.
Okay, it's one thing to have great restaurant-level margins, but like you said, corporate overhead can kill even the healthiest store-level performance. So how does this strong store-level data actually translate to the overall company's financial health? Were they able to keep a lid on those bigger corporate-level costs too?
That's where corporate profitability and operating leverage come into play. It's a good story here too. General administrative or G&A expenses, those are the costs, not tied to a specific restaurant. Think head office salaries, legal fees, that sort of thing. As a company grows, investors want to see these G&A costs grow slower than revenue. That's the concept of operating leverage, getting more efficient as you scale. And CAVA demonstrated clear operating leverage in the quarter. G&A expenses as a percentage of total revenue decreased. It went from 12.1% in Q2 2024 down to 11.4% in Q2 2025. The company attributed this improvement to a few things. Lower performance-based incentive compensation, leverage from higher sales, that scaling effect, and also lower legal costs. So this increasing corporate efficiency, combined with that really resilient restaurant-level profitability we just discussed, it reveals the high quality of CAVA's earnings beat. This wasn't, from some one-time gain or financial engineering trick. It was manufactured by durable fundamental improvements in the business's core profitability.
And this provides a powerful counter-narrative to the market's singular focus on slowing growth. It suggests that while the rate of growth might be moderating, the quality of the business's profitability is actually improving. Now, for slide 3. The engine room business segment performance.
That's a great point about the quality of the profitability, a really important context. Now let's go deeper into where CAVA's revenue growth is truly coming from. This section is the engine room business segment performance.
Indeed. Because CAVA's 20.3% year-over-year revenue growth, it was actually driven by what we can call the two-speed story. It wasn't uniform. The company's press release clarifies that the increase was primarily driven by 75 net new CAVA restaurant openings during or subsequent to the second quarter of fiscal 2024. So basically, you have strong new unit expansion really powering that top-line number. New stores were the main driver.
Ah, okay. But what's truly fascinating and maybe worrying for the market is the same restaurant sales story. This is the metric everyone watches, isn't it? The existing stores.
It truly is. Same restaurant sales, or SRS, sometimes called comps, is one of the most closely watched metrics in the restaurant industry because it measures sales growth at locations open for at least a full year. So it strips out the effect of new store openings and reveals the underlying organic health of the brand. How are the established places doing? And this is where the disappointing deceleration became crystal clear. CAVA reported SRS growth of just 2.1% in Q2 2025. Just 2.1%. That's a dramatic drop from the 14.4% growth they posted in the same quarter last year. Huge slowdown. And it also fell well short of analysts' expectations. The street was looking for something around 6%, so a big miss there too. But the composition of this growth was even more concerning to investors. Why only 2.1%? Well, 2.1% gain was primarily from menu price and product mix, with guest traffic being approximately flat. Think about that for a moment. Flat traffic. That means the same number of customers visited CAVA's established restaurants as last year. No more people coming in the door. The entire sales increase came from those customers paying more per visit, either higher prices or buying maybe more expensive items like that steak. Now, for a growth-focused company, this is considered a low-quality form of growth. It's not sustainable long-term. Long-term success in restaurants depends on consistently attracting more people through the door. Foot traffic matters. The market, being forward-looking, interpreted this flat traffic not just as a weak Q2 data point, but as a leading indicator of future trouble, especially like management said in a fluid macroeconomic environment where consumers might be getting cautious. There's a clear limit to how much you can rely on price increases before customers start visiting less frequently or trading down. So that severe stock reaction wasn't just about the 2.1% number itself, but about the fear of what its composition, that flat traffic, implied for the sustainability of future growth.
That makes perfect sense. Yeah, price and power is great, but without traffic, it eventually hits a ceiling, feels less organic. But there's another side to this coin, the power of new units, which you mentioned earlier. That seems to be a genuine bright spot, right?
It truly is a very bright spot. In stark contrast to the slowing growth at mature stores, CAE's primary growth engine, that new unit expansion, is performing exceptionally well, firing on all cylinders. The company opened 16 net new restaurants just in the quarter. That expanded its total base by almost 17% year over year, up to 398 locations now. Good pace. And most importantly, CEO Brett Schulman highlighted that the 2025 new restaurant class is on track to deliver AUVs, average unit volumes, above $3 million. Unquote. AUVs over $3 million for new stores. That's fantastic. It indicates that the CAV brand concept remains highly portable and successful as it enters new markets. New locations are opening strong. This proven success and expansion is the core of the long-term bull case for the stock. It shows that the company's primary growth lever is still working extremely well. They know how to open successfully restaurants. Moving to slide 4. Financial strength and shareholder rewards.
Okay, that's a critical distinction for investors to grasp. That difference between new unit growth, which is strong, and the organic same-store growth, which has slowed. Very different dynamics. Now let's shift gears slightly to ESV's financial health. How strong are they fundamentally? We're moving to slide 4. Financial strength and shareholder rewards. What does HUD's balance sheet tell us about its ability to actually fund all this growth and expansion? Can they afford it?
Good question. A company's balance sheet is essentially a snapshot, what it owns versus what it owes at a point in time. A strong balance sheet, typically means ample cash and low debt. That gives you financial flexibility. Looking at CAVA's numbers as of July 13, 2025, they had $290.2 million in cash and cash equivalents. That's a healthy chunk of change. Total assets were about $1.29 billion. Total liabilities, $540.9 million. And total stockholders' equity was $750.7 million. So when we analyze their leverage and liquidity, well, CAVA maintains a very healthy and conservative financial position. Pretty strong footing. You calculate their total liabilities to equity ratio, basically how much debt versus owner's equity is about 0.72. For listeners, what that low number tells us is they're largely funding their growth through their own money, owner's equity, not through heavy borrowing, so not much debt risk. This low debt, combined with that strong cash balance, nearly $300 million in cash and equivalents, plus another $95.6 million in investments, gives CAVA significant financial firepower. They can fund those aggressive expansion plans without needing to go cap in hand to the banks or markets.
They clearly have the capital internally to continue opening those new high-performing restaurants.
Okay, so they're financially strong, not much debt. What do they do with all that financial strength then? Are they paying out dividends to shareholders or buying back stock or something else entirely? Where's the cash going?
That's a great question, and it really speaks directly to their strategy at this stage. The press release contained absolutely no mention of dividends or share buybacks, which is honestly pretty typical for a company that's still firmly in its high growth phase. Instead, CAVA's capital allocation strategy is clearly, and you could say singularly, focused on reinvesting its capital right back into the business. To fuel that expansion we've been discussing, you can see the evidence for this. Their year-to-date purchases of property and equipment, that's their capital expenditures, or CapEx, totaled $77.0 million. So they're spending money on building new restaurants and maybe fixing up old ones. This financial strategy is perfectly aligned with the operational reality we've seen. Those new restaurants are the primary driver of growth and are generating excellent returns. It shows a coherent and disciplined long-term strategy. Management isn't distracted by short-term shareholder rewards like buybacks right now. They seem focused on the single most value-creating activity for the business at its current stage: aggressive, profitable expansion. Keep building those stores. Now for slide 5, the road ahead management's outlook and key takeaways.
Right, it's clear they're playing the long game with that capital. Makes sense. Now, let's get to what management said about the future. Because our sources tell us this was the primary catalyst for the negative stock reaction, the outlook. We're on slide 5, the road ahead management's outlook and key takeaways. What did they guide for?
You've hit on the crucial point there. Yes, the primary catalyst, the thing that really tanked the stock, was management's updated full-year guidance. The changes here basically confirmed that the slowdown seen in Q2 wasn't just a one-time blip. It's a trend they expect to persist through the rest of the year. That spooked investors. Let's look at the specific changes. For net new CAVA restaurant openings, they actually raised guidance slightly, from 68 previously up to 70, so opening even more stores than planned. That's positive. For CAVA restaurant level profit margin and adjusted EBITDA, they maintained their guidance ranges. No change there, which is also positive, reflecting that operational strength and control we talked about. However, The significant negative signal was the KVA's same-restaurant sales growth forecast, the comp's guidance. It was cut pretty significantly, from a range of 6.0%, 8.0% previously, down to 4.0%, 6.0% for the full year. That reduction, from a midpoint of 7% down to 5%, was deeply concerning to the market, and our sources note this was the first time CVA had cut its sales guidance since its IPO, ever.
That really cemented investor fears about slowing organic growth at the existing stores, a big symbolic negative.
Wow. So cutting guidance, especially for the first time since going public, what kind of signal does that really send to the market? How significant is that perceived?
It sends a very strong and usually negative signal. It suggests that maybe previous growth expectations were just too optimistic, too high. That reality is biting. Now, CEO Brett Schulman, he started on a confident note in the commentary. He emphasized, during the second quarter of 2025, we continued to grow market share and firmly establish our category-defining leadership position. Standard CEO positive framing. But then he did contextualize the challenges. He noted the fluid macroeconomic environment, which was later characterized in market reports, maybe based on the analyst call, as a fog for consumers. This, he implied, helped explain that flat traffic and the more cautious outlook. Consumers are uncertain, basically. However, Schulman strategically pivoted back to the main positive driver. He made sure to state, our 2025 new restaurant class is on track to deliver AUVs above $3 million, reinforcing the proven portability and underlying strength fueling our continued growth. So, while acknowledging the headwinds impacting existing stores, he made sure to highlight the continued outstanding success of their new unit strategy, trying to balance the narrative.
Yeah, that's a classic management balancing act, isn't it? Okay, so bringing it all together then, what are the key takeaways for the quarter for our listeners? It really does sound like a tale of two growth engines is the main theme here.
It absolutely is. That's the perfect summary. First takeaway, a tale of two growth engines. New unit expansion is strong, it's firing on all cylinders, even exceeding expectations with those record AUVs. But the other engine, the organic growth at existing stores, that one has sputtered, marked by a sharp deceleration in sales and, critically, that flat customer traffic. Second takeaway, future growth fears trump current profit. Despite CAVA delivering an impressive EPS beat driven by strong operational execution and cost control, the market looked right past this. It severely punished the stock for the top-line revenue miss, and more importantly, that first ever cut to full-year same-store sales guidance. Future worries outweighed current performance. And finally, takeaway 3. Profitability and expansion remain core strengths. Beneath the turmoil of the growth narrative, the quarter actually confirmed the fundamental strengths of CAVA's business model. Best-in-class restaurant-level profitability remains resilient. Corporate overhead is being leveraged effectively, and the new restaurant pipeline is robust and exceeding expectations. Those are still very solid pillars. So the final narrative for CAVA's Q2 2025, well, it wasn't a simple failure, not at all. It was more like a crucial inflection point. This was the quarter where the market's lofty, maybe overly optimistic, uninterrupted growth narrative collided head-on with the complex realities of a more cautious consumer, maybe the law of large numbers kicking in, and certainly difficult year-over-year comparisons after a blowout 2024. The impressive EPS beat, born from those deep operational strengths, it demonstrated the solid foundation of the business. They run good restaurants. However, that combination of flat traffic at existing stores and the subsequent cut to future growth guidance, it forced a fundamental recalibration of expectations from Wall Street. The story of CAVA is no longer just about how fast it can grow, full stop. Now it's also about how it can navigate a more challenging environment for its established base. So the central tension for investors, the thing you need to weigh, is now crystal clear. It's balancing that proven high-return engine of new store expansion against the new and pressing challenge of reigniting organic growth and customer traffic across its established base. That's the puzzle going forward.
That's an incredibly clear summary of what was, frankly, a very complex and confusing earnings report at first glance. It really shows the value of doing a structured deep dive like this to understand the numbers beyond just the surface headlines. Okay, just a quick reminder before we wrap up. This deep dive is for informational purposes only. It is definitely not financial advice, and you should always do your own research before making any investment decisions. Please consult with a professional. Also, this analysis was generated by an artificial intelligence model, integrating data from Kitio's official earnings press release with publicly available market data. While we strive for accuracy, always independently verify information yourself. Like and subscribe to stockanalytics.ai YouTube channel. Members get access to our growing library of all S&P 500 stocks and get priority requests for company deep dives.